Inflation throws curveball at Fed. Will 2024 bring rate cuts? The answer may surprise you. Sriram Ananthakrishnan, 360 degrees banker, building global businesses, international trade, treasury markets, trader, structured finance, strategic financial leader. The Fed may just throw a wrench into everyone's expectations of a 2024 rate cut. Sticky inflation is gumming up the works, and with inflation hovering at 3.8% in April, well above the Fed's 2% target, as reported by the Bureau of Labor Statistics, rate cuts are looking like a distant dream. We might be in for a year of no cuts at all. This is a game changer for markets, consumers, and especially emerging economies. Let's dive into the potential turbulence with some data points to consider. Inflation sticks like glue, rate cuts may take a nosedive. Sure, inflation's down from its peak of 9.1% in June 2022, but it's far from the Fed's target. The stubborn streak has them spooked about cutting rates too soon and reigniting inflation's fire. The Fed might be prioritizing price stability over short-term economic boosts, with the hope that a soft landing, slowing inflation without triggering a recession, is still achievable. Market meltdown? Not quite, but buckle up. Investors were all smiles with visions of rate cuts dancing in their heads, with interest rate futures earlier this year suggesting 6 to 7 cuts. Now, that party might be on hold. This could lead to some disappointment and force a portfolio reshuffle for those who placed all their bets on a rate cut bonanza. The S&P 500, for example, has already seen some volatility in response to the Fed's hawkish signals. Consumers, brace for continued borrowing pain. No rate cuts translate to no relief from sky-high borrowing costs. The average 30-year fixed mortgage rate currently sits at 7.10%, according to Freddie Mac, a significant increase from pre-pandemic levels. This, coupled with high credit card APRs at their highest since 1994 according to the Consumer Financial Protection Bureau, could squeeze household budgets and put a damper on consumer spending, potentially slowing down the entire economy. Retail sales growth, for instance, has already shown signs of moderation. Emerging economies feel the aftershocks. The Fed's decisions send ripples across the globe. Emerging economies, where central banks often follow the Fed's lead, might be forced to keep a tighter grip on their monetary policies, potentially hindering their growth prospects. This could lead to capital flight, investors pulling money out of emerging markets, and currency depreciation, further impacting these economies. A word to the wise: prepare for takeoff, or maybe a downturn. A delayed rate cut might cause some market jitters, but a complete crash in emerging economies seems like an unlikely doomsday scenario. However, slower growth and potential recessions are definitely possibilities we can't ignore. Here's your flight plan. Investors, diversification is your friend. Spread your bets to weather the potential market volatility. Consider sectors that might perform well in a high interest rate environment, such as financials or value stocks. Consumers, buckle down for continued high borrowing costs. Time to tighten your belts and adjust your spending plans. Prioritize needs over wants and consider refinancing existing debt if possible. Emerging markets, stay glued to the global economic news and be ready to adjust policies as needed. Diversifying exports and focusing on domestic demand could be crucial strategies. The bottom line: the Fed's decision to hit the brakes on rate cuts throws a curveball at the global economy. By staying informed with data points like inflation rates, interest rates, and economic growth figures, and adjusting our strategies, we can navigate this uncertain economic landscape and hopefully avoid a bumpy landing. Thank you for watching this video. Follow me on LinkedIn, https://www.linkedin.com/in/Sriram77/x, Twitter, Ram Your Voice.